Hey everyone, me Kevin here. I need help. There are two things that I need help with. One of them is market-based, and one of them is not market-based. It's actually an invitation for you. If you'd like to work in person for myself at both of my startups, be sort of a dual enrollment as an intern, consider sending us an email at jobs@meetkevin.com with a 1-minute pitch video and your resume if you've got one. If you don't have a resume, that's okay, but it'd be in anything from accounting intern work, software engineering, finance, little experience, lot of experience, doesn't matter. Consider emailing us at jobs@meetkevin.com. Keep in mind, our interns, and no guarantees for the future for anybody else, but keep in mind our interns that started at California minimum wage and worked for 9 to 12 months at that level are now making over $120,000 each. So keep that in mind. There's a lot to learn. So now let's talk about the market issue that we need help with. So I want to be crystal clear here. I think that the Nike swoosh is going to continue to hold. And the best thing that we could look forward to right now is potentially buy the dip opportunity before the election, as we have election uncertainties start to ramp. But here's why, and it's something I just realized this well. I mean, I've known this, but it dawned on me a little bit more over the weekend, and it's, in my opinion, a huge catalyst. So what's the biggest thing that we're looking at if we're a bear right now, or we're a bull considering bearish arguments? Well, we're looking at Elon Musk losing, we're looking at the broader market selling off due to a rapid increase in unemployment. At this point, the Federal Reserve has basically washed their hands of inflation, kind of are acting like, we're willing to wait. We've gone through all that before. They've washed their hands of wages going up and a wage price spiral. So they've washed their hands of inflation, the wage price spiral, supply chain issues, geopolitics. They've basically washed their hands of every negative catalyst, with the exception of the potential for a sudden move down in the jobs market. In other words, a spike in unemployment or a spike in joblessness. Well, there's something that's already been propping up the jobs market, but that actually may continue to prop up the jobs market for quite a while going forward. And that's immigration, both illegal and legal. Consider this. When the Bureau of Labor Statistics calls us up and says, hey, you got a job, or how many employees you have, they're not asking legal or illegal. This means it's entirely possible that we could be in a situation where we continue to get illegal immigration, and it actually just, and quite frankly, legal immigration, and all it does is prop up, well, certainly existing politicians, right? Politicians today, it doesn't matter, Democrat, Republican, obviously the incumbent president, but also senators and representatives, they like to brag over good employment numbers. And I hate to say it, but the reality is you don't get bad unemployment numbers when the border is nearly wide open, or what feels like it's wide open. It actually helps politicians because the Bureau of Labor Statistics isn't asking about immigration status. They're trying to get clear surveys. And so when they call businesses, how many employees do you have? Or when they call households, how many people have a job in your house? They're not asking what your immigration status is, because then nobody's going to answer their freaking survey. So job numbers actually go up due to all forms of immigration, not just legal immigration. So that actually makes politicians less incentivized to deal with the border crisis, which, if any country should be able to deal with the border crisis, it should be us. But maybe there's a reason we're not, because it actually props up, to some extent, the economy, GDP. It makes the Federal Reserve feel like the economy is popping along. It makes politicians happy because we're not in a recession. Pretty much in a recession, every politician loses their job. But look at what we have right now. We have what feel like rosy employment numbers. We have the Atlanta Fed GDP numbers that just came out on the 24th, 3.5%. These are some crazy numbers, absolutely crazy numbers. Some other things that are absolutely crazy numbers are the fact that we've taken this trading account from like $980,000 to over $2.26 million. If you want all my buy, sell, trade alerts, no guarantees we can have the same success going forward, but let's just say it's going really well. I think I had another $50,000 profit day today. Oh, actually, it might be a little bit higher. I should send in an updated screenshot here, but while I pull that up, we have a coupon code expiring Friday. So if you're not part of it yet, do check out the courses on building your wealth linked down below. It's educational based. I can't guarantee you're going to make or lose money, but I can say I'm going to provide you the best education that I can in both real estate, entrepreneurship, finance, you name it. I did just update that P&L sheet for today, and it looks like with the trades this morning, I was able to get the account up to $2,070,000. So that was another P&L like 50,000-ish a day. So yay, let's see if we can keep those trades going. Anyway, take a look at those courses linked down below. I also want to give a really quick shout out to the wonderful vacation that we just had this weekend. I took some of the trading tendies and I decided to spend them on a really cool vacation with the family. And so what we actually did is we went to a ranch and we got to do some really cool, fun things. Not only stay in cabins, but drive these golf carts around, 5-star restaurants. Just peace and quiet, away from technology, dude's trip. We did compound bows, regular recurve bows, so archery, horseback riding. Just a really good time out in nature, away from tech. I did wear a helmet because I think my entire staff would kill me if I didn't wear a helmet when I was on the horse, although it's much cooler to wear a cowboy hat, especially since we got rodeo over there as well. So really, really fun time, fantastic time, roasted marshmallows with the kids too. There's Sasquatch. Max is taking on Sasquatch. So really, really good time. But anyway, okay, let's get to the topic. So what I need your help with is trying to understand where the negative catalysts are. Because here's the thing, I want you to think about this for a moment. Negative catalysts, what do we have? We have the 10-2 yield curve inversion. That's it. 10-2 yield curve inversion, or the 2's 10s we call it. The inversion right now sits at negative 44 bips. That's a bad omen. But right now, the reason we're getting this long, basically inverted yield curve is because we're being propped up on the jobs numbers, partly because of this immigration issue. As a result, interest rates will probably, as we've heard already many times before, stay higher for longer. We're only pricing in, as of right now, we are only pricing in 1.37 rate cuts. That's a chunk lower than what we were pricing in last week. Yet why then is the NASDAQ-a-doodle up 18 bips? Well, the reason is, unfortunately, I don't think there are enough negative catalysts right now, unless there's a black swan event, to say bad things are coming. Earnings are past us. They came in substantially better on a PE basis than we expected. That's basically, we're looking at, here's where we thought the PE levels would be. Earnings came in higher. Oh, wow, that was off expectations. So PEs are actually lower than we thought, price to earnings ratios. Bottom line is earnings came in just substantially better than expected. Not only did earnings come in better than expected, but inflation is still on a substantial downtrend. And after the latest inflation report, we saw our 5-year break even, which was starting to rise, settle back down. We're at 2.34 right now. This is nowhere near the spike we had in March and April when we had a little bit of that S&P and NASDAQ sell-off. It was a buy the dip opportunity, but boy, it was a short one. And so this is where I need your help finding bearish arguments. I want you to leave comments down below. Is it the housing market? We did a housing market video last week where we had Mr. Barry Sternlick halting with redemptions. But he wasn't halting redemptions because the market was plummeting. He's halting redemptions because he thinks this could be the bottoming of the real estate market. He actually thinks the boom is ahead. That's great for House Hack. You know, we're looking to expand our purchases as we speak. It's one of the reasons I'm looking for more interns so we can really start establishing our outposts in some of the different markets that we're working to expand into. So we got inflation data. We talked 2's 10. That's really the only bad omen. Inflation expectations stable. We talked jobs data. We know GDP data is booming. Again, the only bad data we're getting out of GDP data, which we do have a catalyst this week on GDP, is that exports are weak. and of course, inventory buildup. But that makes sense. I mean, this morning I was talking to course members about Ubiquity and a fundamental analysis on Ubiquity. I'll pull up one page here that I think you really ought to be paying attention to if you're not already. And keep in mind, GDP for the second estimate is only expected to be 1.3%. That comes out in 2 days. That's a Thursday morning catalyst at 5:30 in the morning. Probably trade it. But anyway, look at this right here. And remember, it doesn't so much matter, the GDP report, because again, you got to strip out exports and inventory buildup. So what's going on with inventory buildup? Well, companies aren't actually building up inventory anymore. Look at Ubiquity. Inventory's 737 million down to 533 million. Why is the inventory starting to get drawn down? And why all of a sudden are we going from spending $500 million in, I think this is 9 months for inventory, to gaining $181,000 on inventory, or sorry, $1 million on inventory? Well, it's because of what's called inventory drawdown and the expectation that supply chains have gotten so loose that if you need to manufacture more, you can just pick up the phone and go, yo, double the order. And the manufacturers are like, sure. The only place you're really seeing a manufacturing shortage right now is in being able to get out the advanced GPUs like the Blackwells. You still have supply shortages there. But as far as manufacturing otherwise, broadly for generic Internet of Things tech and a small to medium-sized business recovery as rates start trending down eventually, Ubiquity is an interesting play. Actually, at the time of this video, not exposed to it, but I'm looking at it. It's had a rough year and a half, but it's getting interesting again, and it's had a little pop recently after earnings here, after we got this sort of data. But anyway, just being transparent. So I'm looking for bad data. I don't see it in housing. Yes, inventory is rising, but we anticipated that happening, and that is going to soften markets, especially in overbuilt markets. So yes, there will be some softness in housing. Commercial softness is going to continue for a while, but that's fine. Then you've got consumer spending still robust. I realize that lower incomes are suffering. You have higher interest expenses on autos, car values are going down at the same time, credit cards, defaults are going up, but just because the lower end has like a little smoldering doesn't mean the entire economy is going to tank on that. You can smolder and frankly just burn people's wealth, the little that folks on the lower income spectrum have for much longer without the economy turning. So then you're really looking at maybe a banking crisis, but frankly, we haven't had a banking crisis since the Bank Term Funding Program ended. And as they start cutting rates, you're actually reducing the odds of a banking crisis. Some people say, oh, well, what about the T+1 liquidity challenges? I mean, yeah, you could have some weird one-off liquidity issue, but the Fed's just going to bail that out right away. So then you've got geopolitics, China, Taiwan. But as we've researched many times before, those are some of the best buy the dip opportunities. Like right the moment of invasion, you buy the dip, and then you just slowly melt up in that Nike swoosh pattern. I think we are heading towards a trajectory of NASDAQ all-time highs. Not only NASDAQ all-time highs, which obviously we're already on. Let me clarify that. NASDAQ inflation-adjusted all-time highs. That's a big difference. NASDAQ inflation-adjusted all-time highs are probably going to put you somewhere around like 518 on the Qs. And our next Fibby right here is 501 on a Fib extension. Now, I know a lot of people get pissed at me when I talk Fibbies and the extensions. They're like, oh, this is just Fugazi. But if you go back to my Nvidia videos, when people ask me, Kevin, what's your next breakout support level? I go 1116. It was just a simple Fib extension. And look at where we're trading today. We're literally rubber banding around the 1116 level. These are the things that I like to trade. I like to trade trends that I'm noticing, and you can actually see this live in my course member live stream this morning. In the live stream, which is in this early 7 o'clock hour, we started it right here like 7:02, and we're going live. I drew these very, very simple consolidation lines here on the minute, which also gets reiterated on the 5-minute chart. And I said, this is dangerous. This is probably going to break down. It happened live. Like if you haven't joined the courses yet and you join that live stream, You could literally watch me say, this is probably going to break down. I don't know with certainty, but I'm like 60% this is going to break down. And sure enough, it breaks down. And it's been worse for the rest of the day since. So those are the things that I like to teach. Those are the things I like to trade off of. Again, I can't guarantee we can always be profitable. But so far, let's just say, great day today. I traded the Virgin Galactic rally, traded Tesla, and I lost money on Celsius. The reason I lost money on Celsius is because I saw that consolidation pattern and I said, I'm out. I'm going to cut my loss. I'm not going to hold. I'm not going to diamond hand that trade. So I think I was down like 15% on that one. Obviously, my Tesla trade offset that, and then Virgin Galactic substantially. That made the bucks today. But anyway, so like I say, not everything's going to win or lose. That's my realized P&L today. That's why the account moved from 2020 to like 2070. So just over $2 million. But anyway, join the Stocks and Psychology of Money group if you want those buy-sell alerts. So at least you could see what I'm doing and you could trade around it. I usually recommend people look for the idea and not copy trades. Actually, I always recommend that because I don't give people personalized advice. Don't copy trades. But anyway, okay, so what else? So, okay, the Qs can get to an inflation-adjusted all-time high. People are going to be pissed. Like, bro, I've been milking money markets for 5%. Why did I have the money there in cash when, the market's moving up substantially more than that? That realization, I think, will just continue to come, especially as we get softer inflation data in the second half. And now Jay Powell could be lying through his teeth, but just know what we have coming up. We have the CPI release coming up in the middle of next month. And you want to know what the estimates right now are for CPI? Month over month, 0.1%. Okay, well, that's nothing. And then if I look at the core, we're at 0.316 on the estimate. That's core services. That's let me look at the survey here really quick. Oh, I'm sorry. The average is actually 0.29. So no, at least not currently surveyed. We could always get black swan and rug pulled. That's where trading and hedging can come in to help. But can I really advocate for saying, there's the next big catalyst around the corner? No, I don't see it. And again, maybe I'm blind to it, and that's why I need your help. Not only email me if you want an internship, but jobs@meetkevin.com with a 1-minute pitch video in your resume, but also, where are the negative catalysts? Where can I be bearish? So it's not GDP. I don't think it's housing. I don't think the yield curve inversion is going to do anything for us yet because of the immigration issue. The immigration issue is just keeping everything propped up, which does mean higher for longer. That does burn small caps, small businesses, and unfortunately poorer individuals. But manufacturing's coming out of a recession, not going into a recession. The data we've been looking at shows us that we're actually potentially, like the Deutsche Bank piece we talked about last week, we're actually coming out of what they call this sort of like micro or faux recession, where everything had this sort of like cyclical recession. The semis had their first recession, then they recover out. Then you had the mega caps, they recover out of their recession and the layoffs. Then you have, basically the last ones here are probably your interest rate sensitives, but you're actually starting to see this recovery on the interest rate sensitives too. Now, people ask me about Tesla and Enphase. Oh, look at that. That trend's actually continuing if I extend this a little bit. People ask me about Tesla and Enphase. Enphase is actually a more pure play interest rate sensitive investment than Tesla is right now. The reason for that is, obviously markets are going to start pricing in rate cuts, but the reason for that is you have a lot of negative catalysts for Tesla. I hate to say that. I'm a Tesla fan. I have exposure to Tesla. But you have to keep this in mind. The mode of full self-driving is wearing. And people who think that the mode of full self-driving is not wearing have a stick so far up their behind that they're deluding themselves. I want you to think about this. I bought a Tesla at the end of 2017, and full self-driving had really been, FSD. People have really been using that for about a year then. So say 2016 to about 2023. You have this run of full self-driving. It's about 7 years. 7 years to get from the early versions of FSD to version 11. Then, in the last year, you basically delete all of that. You take that data you've collected, and you run it through 35,000 H100s, and you spit out version 12 in a year. Okay, wait. So that means We created a better version of full self-driving in 1 year than we did in the 7 years before that. Okay, that makes sense from a technological point of view, but where's the risk here? Well, the risk is Blackwell chips could do it with 4 times fewer chips. So think about this. 35 divided by 4, somebody would only have to buy about 9,000 Blackwell chips, and they would have the same compute power, assuming they had the data, to build out an FSD stack. Now, obviously they don't have the data that Tesla does, but what do you think we're going to start seeing build out over the next 1 to 2 years? All the autos, and they all suck with their ADAS right now, but Toyota, Mercedes, Ford, GM, they don't hold a candle to Tesla right now. But BYD, XPeng do, and what are they all doing? They all start collecting data. Then, look, only 1 iteration over from the H100 to Blackwell, you need 4 times fewer chips. What about next year, when you have Blackwell 2.0, and you only need 4,000 chips instead of 9,000 chips, let's say? You get another 4x improvement, right? Well, now all of a sudden somebody gets data between now and the end of next year, the end of 2025. Now you train it, potentially faster as well. By mid-2026, my guess is you're going to start having FSD versions at companies like Ford, GM, Mercedes, BMW, Toyota. All of a sudden, the FSD moat from Tesla, burn! That's not good. Now, some people are like, but Kevin, why don't people just license from Tesla? Tesla told you themselves that it would take 3 years to see Tesla FSD licensing from contract today to in someone's vehicle in production on the road, 3 years. Well, with today's Nvidia technology, they can literally do that themselves in 3 years. They could have their own FSD in 3 years. Collect data now, over the next year, year and a half, train it on chipsets that are as powerful as we have today, where we can run simulations to catch up on the data lead that Tesla has. The reality is the success you have in FSD curves out. We know that. Nvidia told us that themselves. You know, I saw a video from somebody, I don't even know why I watched it, but they're like, oh, you know, the most bullish thing ever for Tesla was Nvidia shouting out FSD. And I'm like, are you smoking crack? That was the most bullish thing for Nvidia, not Tesla. Here's the chart I was just referring to. Progress curves out over time as cost goes up. So Tesla gets bogged over here at the end while everybody else can catch up really fast. You know, everybody else can get to 98% while Tesla's working on the last percent. See, but the shout out from Nvidia was actually the most bullish thing ever for Nvidia's edge case scenario simulation training and data training, because now any other OEM can use the Nvidia Orin platform, which isn't even out yet, and they could use the Orin platform to, let me correct this. Nvidia Drive Thor, powered by Blackwell, will replace Orin. We're on Orin right now. Thor is going to be the new one. But anyway, this platform is going to be one of the biggest FSD competitors to Tesla. I am convinced. And guess what? It's true software as service. Because NVIDIA is designing chips, they're not manufacturing them, so they're selling you a design, obviously in a completed chip product, but then they're also licensing you the FSD software through NVIDIA Drive Thor. It's insane. Now, obviously, I think that's one of the reasons why NVIDIA is actually up 5% today and Tesla's down 2% today. You also have some of the other issues with Tesla, like, the vote for Elon Musk. I still think, and I'm not advocating for one way or the other here, but I think some people are going to vote to punish Elon because they think, he said he was going to build out a supercomputer stack at Tesla. Now it's not. Dojo is just an edge case. Instead, we're going to build out the supercomputer stack over at XAI. Great. And you've already been recruiting talent away for AI from Tesla over to XAI because that's your new latest and greatest whatever. I think people are going to punish him. So I'm not saying that people should vote against Elon here because, commitment made is a commitment that should be honored. But people are going to go back and they're going to justify and go, it wasn't properly disclosed. Vote no. And there's your out basically for saying you're backing out on a deal. And I think people are going to punish them. This is going to be a very tight vote. And so this is a big catalyst between now and June 13th. I think if the vote goes through, the stock can actually go up again. But if it doesn't, you might actually already be pricing in a lot of that negativity, but I'm not certain. But anyway, there are some concerns about the long-term moat of Nvidia, of Tesla's FSD, and I think that's worth paying attention to. One of the reasons I say that Enphase is a more pure play than Tesla. So something to keep in mind. So yeah, I mean, other than that, boy, I mean, I think your next catalyst really is a Microsoft breakout here. Look at Microsoft stuck at the 430. That's your next catalyst for Microsoft. An all-time high on Nvidia would be nice to, on Meta would be nice to see. And Apple's just chugging along on its recovery. I was buying the crap out of it over here at the 169 level. But anyway, you want all my buy-sell alerts, make sure you're part of the Stocks and Psychology Money group. Coupon expires this Friday. Email us for bundles at staff@meetkevin.com. If you go to meetkevin.com, you can see various different topics here. You see the next coupon expires this Friday at 11:59. You can see the various different programs you can bundle up. The Vegas Symposium, check that out. You can join this if you want. Got some bundles up here as well. And by the way, this is pretty cool as well. Not a lot of people know about this, but we put a secret link over here. It's not really secret now that I'm telling you about it, but anyway. This is the Wealth Plan Library, and this is basically where we did 37 actual financial advice lectures for people's specific scenarios to say, this is the one thing that you should really be focusing on now to get your wealth to the next level. We did that in a confidential way, so like their names aren't in it or their personal information. But you can actually buy those 37 recordings if you want. So check that out. A lot of people are bundling that together. It's pretty cool. And it's a very, I think, affordable price as well. So check that out. But otherwise, thank you so much for being here. Really appreciate you all. The video is also brought to you by Coinbase. If you haven't checked them out yet, go to metkevin.com/Coinbase. And when you go there, you can get up to $200 in free Benjis if you sign up for Coinbase. I personally think Coinbase is the place to trade crypto, and that is, and we've got an institutional account we're setting up with Coinbase as well, which is kind of cool. And so we're pretty excited about maybe even using in the future Coinbase for on-ramping and fundraises. Be kind of cool. There's some cool things we can do there, especially with real estate and mini funds. So a lot of cool things we've got cooking. We're very, very excited. Hence also why we are looking for interns. Email us at jobs@meetkevin.com for a potential internship role. Thank you so much. It is in person. Remember that. We'll see you in the next one. Goodbye and good luck out there.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than Househack, nor am I presently acting as a market maker. Make sure if you're considering investing in Househack to always read the PPM at househack.com.